Ladies and gentlemen, good day and welcome to Q2 FY23 earnings conference call of NGL Finechem Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Mehra from TIL Advisors. Thank you, and over to you, sir.
Thank you, Rutuja. Good afternoon, everyone, and thank you for joining this Q2 FY23 earnings conference call of NGL Finechem Limited. The results and investor updates have been emailed to you and are also available on the stock exchanges. In case anyone does not have a copy of the same, please do write to us and we'll be happy to send it over to you. To take us through the results of this quarter and answer your questions, we have today with us Mr. Rahul Nachne, Managing Director, and Mr. Rajesh Gavande, Full-Time Director and Chief Financial Officer. We will be starting the call with a brief overview of the financial performance, which will then be followed by a Q&A session. I want to remind you all that everything said in this call reflecting any outlook for the future, which can be construed as a forward-looking statement, must be viewed in conjunction with the uncertainties and risks that the company faces. These uncertainties and risks are included but not limited to what we've mentioned in our annual reports, which you'll find on our company website. With that said, I'll now hand over the call to Mr. Rahul Nachne. Over to you, sir.
Thank you very much, Abhishek. A very good afternoon and a warm welcome to you all on our Q2 FY23 earnings call. I believe that you must have gone through the reported numbers and the earnings presentation that has been uploaded on the stock exchanges. Despite a year-over-year decline in reported numbers, we believe our performance has been reasonable in Q2 FY23, given the current operating environment. We continue to face several headwinds, which led to subdued demand and a decline in our financial performance. On the demand side, we observed a high level of uncertainty among our end customers as a result of the ongoing crisis in Europe and the high rate of inflation in several developing countries. Because of this uncertainty, the entire supply chain is attempting to rationalize their inventories. As a result, demand has temporarily decreased. Furthermore, as you are all aware, we export our products to China, where the lockdown remains in effect in various areas. In addition, the negative movement of currencies has had a significant impact on the purchasing power of some countries, and the demand continues to be subdued. Thus, a majority of the year-over-year decline in our top line is attributable to a decline in volumes. However, I am pleased to report that we have not lost any market share during this time, and we continue to maintain our leadership position across all of our key products. Positively, our strategy to begin maintaining low inventories at the beginning of this fiscal year has paid off well in this environment, and we are not stuck with any high-cost inventories. During this phase, we have also refrained from implementing our strategy to outsource manufacturing, as we are not yet operating our plants at optimum capacities. In addition, we are observing a decline in logistics cost and an improvement in container availability. Our interactions with our customers have led us to believe that the demand scenario will begin to improve beginning in the fourth quarter of fiscal year 23, that is Q4 of FY23, and we are already observing a few encouraging signs. Our margins this year have been a little subdued due to the aforementioned factors, but we remain confident that once demand recuperates, we will return to our historical margins. Finally, on the ongoing capex plans, we are reviewing the project cost in light of the reduction in metal prices. We have commenced renegotiating with our vendors. Once we have more clarity on this matter, we will provide you with an updated estimate of the capex outlay. With that said, I am now open to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Hello. Hello.
Please go ahead, Mr.
Yeah.
Ahuja.
Thanks for the opportunity. And sir, in a tough environment, maintaining market share surely is appreciable. A couple of questions from my side. Firstly, sir, you have mentioned in your initial remarks and also in the presentation about early signs of demand reviving back. And so typically, do we see now going ahead things improving on quarter-to-quarter basis, seeing the improvement from Q3, both in terms of demand and also pricing? In the previous call, you had mentioned that the pricing pressures had continued at Q2, and you had expected that it will start easing from Q3. That is my first question, sir. Hello.
Yeah. Thank you, Rahul, for your question. With regard to when we said we see early signs of demand revival, it means that there are some of our customers who have started expressing interest and are giving us, new inquiries for their demand. Quite a few customers still continue to carry high stocks, which they had bought during the last financial year. But we anticipate most of this destocking to take place probably by the end of this year or towards the latest by the mid of next quarter. So yes, we are seeing demand reviving now. We are seeing some inquiries coming. It hasn't translated into orders yet, but we are seeing early signs of this recovery. With regard to pricing, pricing has always been under pressure because the prices are pretty inelastic and all price increases cannot be passed on to customers. But at the same time, we are seeing a ease back on our purchasing costs. Chemical and commodity prices have started softening a bit, and there is definitely a easing of pressure on that side. I hope this answers your questions.
So we will see gross margins improving now year onwards. We have seen a marginal increase on the gross margins in the previous quarter, the Q2. So can we see that this trend of improving gross margins will continue now in the next 2-3 quarters to come? So we'll see some improvement every quarter?
Yeah. I think the first quarter in this year was pretty much dismal. We saw more or less the worst time of the year. The second quarter, as compared to the first quarter, has already seen a significant recovery. Prices of chemicals started going down around July of this year, and they continue going down. So, and we have seen them now start bottoming off around this time. So there is definitely an advantage. We are pretty sure that margins will improve from here onwards.
Sure. And sir, on new product development, you had mentioned in the earlier call 2 new products, the pilot trials were completed in the previous quarter, that is Q1. And in the current presentation, we have spoken about completing the ongoing pilot trials for another 2 products in Q3. Is my understanding right? And so typically, does that mean in the current year, say by December, there will be total 4 new products which will come into the pilot stage being completed? And with regard to these new products, when do we start generating revenue from them? What is the likely sales possible for us from these 4 new products in FY24 and FY25? And typically, what is the potential size of these products, market size?
Yeah, see, our products have, we are totally planned on 5 products to be taken through the pilot plant in the current fiscal year. 2 were already done earlier, 2 more were started last quarter, which will continue on in the current quarter. And there is 1 more product which is being slated, which will start in December and probably go until March, because that's a multiple step product. So there are a total of 5 products. Commercial sales typically start anything from 6 months to 12 months after the pilot trials are complete, because it takes us 6 months to complete the stability data, which most of the customers ask for. So we use that time to do the sampling and approval, pre-approval stages, and then the commercial sales start. So whatever we are planning in the current year, sales will start probably towards Q3 and Q4 of FY24.
And the market size of these 5 products, and what is the potential sales which we can do from these 5 products in, say, FY25?
I think there is a combined sales potential of roughly about 40 crores from all these 5 products.
40?
40, yeah.
So then I have some confusion, sir, because in the previous call, pardon me for my confusion if it is so, you had mentioned that the total market size is around 1500 crores, and with these 3 new products, you had mentioned that the size will increase by around 800 crores. So am I missing something?
That is the total potential. In the first, I am talking about what is the potential for us for the first year or 2 years.
Okay, sure. Okay.
Yeah, so that potential total remains, but it will not mean that it is going to be turnover which will be attributable to us.
So sorry, I got it wrong. I think what you are saying is,
what is the total amount which we can hope to generate from this? It will be in the range of 40 crores in the first full year of sales. Sorry, not the first, probably by the second year, we should be able to generate about 40 crores sales from these products.
Sure. Pardon my misunderstanding. I got it wrong. So now I got it right. Just last thing, sir. The greenfield capex, we had spoken that we are hopeful to commence the greenfield capex somewhere in Feb 24. So we continue to maintain that.
Yeah, in fact, we have already restarted the entire purchasing exercise now. Civil construction is roughly 60% complete for the site, and we have now started the procurement process for the equipment. So probably in the next 30 days we will have a re-estimated on the cost, and we will commence our ordering. So yeah, we are still on track to start ordering by Feb.
Thank you so much, sir. Thank you so much. Wish you all the best.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Yogansh Reswani from Mittal Analytics. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, my question is again on your product basket. So I was looking at your presentation, and top 10 products are now contributing 70% kind of revenue. And if we look at the market share that we have in top 5-7 products, it will be higher, say 40-50% kind of market share. So just from a thought process, if you could share, what is the kind of growth that we can still see from these products? I mean, with this product combination, we are at 300 crores, right? And our aim is to be around 500 crores in next couple of years. So going forward, this growth that we are envisaging, is it mainly from these products, or is it solely from the new products?
So we have seen pretty subdued demand in our top 3 products, and you can see that our share of top 3 products has gone down from probably around 35% earlier to around 27%. So that is not because of loss of market share, but because overall the demand for these products has been pretty subdued. But the sale from the top 10 products has actually remained at around 72% as compared to 75-80 earlier. So the other products are slowly increasing in their total volume and quantity. So to a large extent, broad basing the product range has helped us to tide over these issues which are coming up right now.
Right. So what I was also trying to understand, sir, what is the potential for these products wherein we have 40-50+% market share? So is there a scope to further go any higher from these products? Do we still feel that we can, get some more business out of these products, or going forward, our majority of the, incremental business has to come in from the newer products? The heavy lifting has to be done by the newer products.
So the top 3 products are more or less in their matured life cycle. So we can expect only incremental, sales coming from increase in the natural growth which takes place in the market, which is likely to be in the range of anything between 8 to 12%. So most likely larger growth will come to us from the newer products. I am talking about the next 5 years for us. Larger growth will continue to come from newer products which we have added to our basket.
And so in terms of selecting these newer products, how is the thought process now? Because now the scale is bigger. So are we now targeting at molecules or products which are typically higher of higher value? Because I think you mentioned 40 crore is the NGL target, while I think market potential you said is for 1500 crore, right?
No, market potential of total NGL's basket is over 1500 crores is what I had said. We are probably at 300 crores on that right now. And the new products which we are taking right now, those will add to another 40 crores for our sales in the first or second year of its operations.
Okay, and these new products that you are starting off, what will be the market potential of these?
That's what we have just said, no? Total market potential. Market potential should be in the range of about 400, 500 crores for these products.
Okay. Yeah. Thank you.
Talking about overall market size, no, for those products.
Yes, for the overall.
Yeah, global market size, yeah.
400, 500 for all these 5 products combined.
Correct, yeah.
Got it. I'll get back in the queue for it. Thank you.
Thank you. The next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, sir. Good afternoon. So my first question is regarding the realization. So we have taken some price increases in last 6 months due to higher RM prices. So our realization would have gone up, right? So and our volumes have gone down. So if we go back to the same volume as we were doing, let's say last September or December, our revenue potential will be higher than what we were doing at that point in time. Is that understanding correct?
Assuming that the prices stay at the same level, but as the chemical prices go down, prices will also start going down.
Okay. So that also comes with a lag, or that happens much faster than the price increase?
That happens much faster.
Okay.
Unfortunate, but yeah, true.
Okay, got it. Sir, second question is on the new products. So, sir, wanted to get some better understanding on this, because last call we had mentioned that these 5 products will have a very large potential and numbers. I think last call we were saying around 700, 800 crore. This call we are saying around 500. So let's assume 500 to 800 crore, anywhere there between. But our total product basket of 20 products has a potential of 1500 crore, and 5 products has a potential of 500 crore. And I think you had mentioned last time that the predominantly Chinese players are there in this product, and will still expect to make 55% kind of a gross margin. So very competitive market, you are saying, but we still make good gross margins, much larger products. So how does this fit in? And I mean, is there a potential for us to do 20-30% kind of a market share even in larger products, or we think that we'll be at a much lower level in the product, maybe 3, 4, 5 years down the line?
The market share to build up typically takes anything from 5 years to 7 years. It doesn't happen overnight.
Right.
Because there are well-entrenched people in the market, and to displace them, it takes a little longer. Now, why we are confident about the margins on this product is, the product is a almost 13th chemical stage of synthesis. Mm-hmm. So obviously, it is a highly backward integrated product. One of those. 2 of those are not as backward integrated, probably about 4 or 5. So overall, we hope that the mix should help us to retain the same level of gross margin.
Okay, got it. And is it that we'll be competing mainly on the price and service that has been the case so far with all our products? That will be the only thing we'll be competing on, right? Even if there is Chinese competition.
See, we are in a B2B business, and in a B2B business, there is no branding, there is no brand image which helps you get a higher price. It is always a very price competitive market.
Right. So I'm trying to understand is that will we be as competitive as Chinese guys and take away market share? I mean, where does that confidence come from? That is what I want to understand. Okay,
so it's not an easy thing which will happen overnight. It is definitely going to take us over a year to get the expertise and the efficiencies up to a level where we can start and compete with them on their own footing. But we have done it in other products earlier, and we are quite confident of doing it in the current products also.
Got it. As a last question, you said that we will reconfigure our capex number post we receive the bids on the equipment side. So, are we expecting a much higher number or than 140 crore or a slight reduction in that number?
So we have started reviewing that entire cost now, and the exercise is continuing right now. We just started this probably about 2 weeks ago. So it's too early for me to tell you whether it will go up or down. We will need a little more while to work it out. Probably I'll be in a better position to address this in the next call.
Okay. No worries. Thank you and all the best.
Thank you. The next question is from the line of Nasir Parekh from Native Capital. Please go ahead.
Hi. Thank you. Mike, a couple of questions. First is on the top 5 products, where we have 50% plus market share. What would be the growth rate in that market right now? Is it declining, flat? How should we think about it?
Well, very frankly, this year we have seen at least a 20% drop in volumes.
And we should expect that to continue, or?
We are very hopeful that it will revive in the next year.
Okay, got it. And, on the business development front, how do you think about, revenues going forward between, say, the top 10 and other customers and, other new customers that we are adding? And the reason I ask is, you've given the mix for top 10, other than top 10 has obviously gone down, much higher at around 30% year-on-year drop. So, how do you think about adding new clients beyond top 10 and the revenue potential there?
What has happened is that when the volumes have dropped by almost 20% now of our top 5 products, the larger customers have been able to keep their market share. So they continue buying the same amount. But overall, the smaller customers have lost more than 30% of their market. So there is a temporary imbalance over there, which should correct in the next year.
Understood. Got it. And last question, in terms of, the new product development, etc., that you're talking about, where is it that we are trying to win? Like, is it the cost position that we are trying to win in? Or, is there some complex chemistry or something like that, which is difficult to do, we're trying to do? Like, what's our strategy and focus area over there, especially on new products?
So there are 3 parts to it. The first part is we are looking at products where there is no supply other than China. So there are 2 products where we are taking on, which we have taken on now, where we would be the first producer in India for those products. The only producers are the Chinese. The second part which we have been trying to do is to develop the chemistry skills so that we can produce these products, efficiently and at the same time be competitive in the market alongside the Chinese. And finally, when we have the product, we will have to go with a price point which is equal or a little lower than the Chinese, otherwise we will not get the market share required for it. So all these things have to fall into place for them to succeed, the launch to succeed.
Okay, got it. Thank you so much.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Shivan Sirvaya from JHP Securities. Please go ahead.
Good evening, sir. Am I audible?
Yes, you are. Please
Yes.
go ahead.
Yes, sir. So, some understanding on our product portfolio. So, out of the 22 APIs that we currently have, sir, what would be the mix between companion animals and farm animals and poultry? If you could give a broad understanding there.
So right now, whatever we manufacture is going completely into farm animals only.
Okay. Okay.
There are 2 products which we are manufacturing which have a potential to go into companion health also. There are some companies which are doing it for companion as well as farm, so we really don't know the breakup or how they are using their products. But otherwise, most of our products are for farm animal. And for poultry, right now we have just 1 product.
Okay. And so, sir, you said that some of the companies that we give to, they use the same API maybe for a companion animal formulation also. Is that the understanding?
Yeah, it is the same product, yeah.
Okay.
The dosage changes because the body weight of companion animals is much smaller than that of farm animals. So the boluses become small tablets.
Okay, but we do not have any understanding on what the mix would be. Means how much of our sale is going towards companion and how much is going towards farm.
No, if we were doing exclusive products which are exclusively for the companion health market, then we would be able to say that very clearly. But there are clients who are present in both the markets, so we don't know how much they are selling where.
Okay, okay. And sir, the distribution chain would be similar for both the segments, or there would be some change there when you go for a farm animal sale or go for a companion animal sale?
So in companion animals, the market is very well segregated basically in Europe and USA.
Okay.
In rest of the world, it is not well segregated, which means that the same company is making it for both the markets.
Got it. Got it. Got it.
So, and we operate mainly in the rest of the world markets.
Correct. Correct. And sir, if I recollect correctly, all our sales are directly to the formulators. It's not through distributors, right?
Very small percentage goes through distributors, but yeah, over 90% or probably around 95% is straight to end user.
Okay. And sir, you've mentioned that we supply to 5 of the top 10 the global animal healthcare companies. So sir, what portion of our sales would be attributable to that?
Oh, I don't have that number to give you straight. Sorry on that.
Okay, sir, I'll take it offline. And sir, my last question, I had come across this article which spoke about antimicrobial resistance in humans and the European Union ban on the use of antibiotics, so routine use of antibiotics. So, sir, how does this affect our business? I know we are not there in the regulated markets, but would this have any bearing or any effect on our products or the markets where we are supplying to?
Yeah, so Europe has mandated a 70% reduction in the use of antibiotics for farm animals.
Correct, yes.
So this started in 2016 and over a 6 or 7 year period, I think which ends next year, they have mandated a 70% reduction from the levels in 2016.
Okay. So
and it has definitely led to an impact of wherein the total market has gone down. For us, this really does not have any impact because of 2 reasons. Number one, we don't make any antibiotics. And number two, we are not present in Europe.
Okay. Got it, sir.
These are basically antibiotics which are also used for humans. So it is mainly penicillin-based derivatives. So those are the ones which have been cut down.
Okay. Got it, sir. Thank you for answering my question, sir. Thanks.
Thank you, Shivam.
Thank you. The next question is from the line of Rajat Sethia from iThought PMS. Please go ahead.
Hi, thanks for the opportunity. So just one clarification. The reason for the drop in top 5 products by 20% is basically stocking up last year and now destocking is happening, correct?
Yeah, that is our understanding, yes.
Okay. Because I was just wondering, because these are essential products. I mean, if you got to use, you have to use it. So there is no decline in demand as such, but it's largely stocking up that happened last year is leading to this.
No, there is definitely a decline in demand also for it because the prices went up due to the commodity prices. When prices go up, people move to substitutes. So now prices have started correcting and started coming down. So we are hopeful of demand getting restored from the next year onwards.
Okay. So what exactly the substitutes? I mean, cheaper medicines or?
So there are two parts to it. Number one is substitutes. Number two is that farmers just cut down on their overall cost because in the end this is being sold by us to other pharma companies. Pharma companies are started in the end selling it to farmers. Farmers need to make money finally from their produce. So they just cut down on the treatment for their livestock.
Understood. Okay. So second one, once this destocking normalizes and all, so what kind of normal growth you envisage for the top 5 and the next 4 products?
So we hope that over a period of time it will normalize back to at least levels which we did last year. But I guess it will take at least a couple of years because last year was pretty exceptional. We saw huge growth in those products. We anticipate it should grow between 8 and 12% for the next 2 to 3 years now.
Okay. All right. And what was the volume growth in the first half?
That's the range which I am talking about, 8 to 12%. I can't be more precise than that.
No, sorry. Volume growth in the first half has been 8 to 10%? My question.
Volume has fallen by almost 20% in the first half.
Okay.
There is no growth. There is a degrowth of 20% in the first half.
Okay. All right. And finally, on the freight cost, in terms of what kind of, if you can quantify something for us, I mean, what kind of declines, freight or power and fuel, what kind of declines are you seeing now?
Okay, so I'll give you examples. A container of freight to Europe, pre-COVID, used to cost us roughly about $1,200 to $1,400. Last year, during the container crisis, it went up to about $10,000, $10,500. In fact, I remember one container we had paid $11,200 for one container at the peak. Currently, it is down to roughly about $3,500 to $4,000.
Okay.
So it is still 3 times what it was pre-COVID, but at the same time, it's come down almost 75% from the all-time high.
Correct. Understood. All right, sir. This is really helpful. Thank you so much and wish you all the best.
Okay, thank you.
Thank you. The next question is from the line of Rohit Balakrishnan from iThought PMS. Please go ahead.
Yeah. Am I audible, sir?
Yes, you are audible.
Okay. Hi, sir. Congratulations on decent performance in this challenging environment. Sir, I had 2-3 questions. So one was in terms of the new capex. So you said that you have done, you've started the work and 60% civil construction is done. when do you anticipate it to be operational? We had said in FY24. I was not clear. I think you mentioned a timeline in this call as well. I could not hear it. So if you could just repeat that.
Yeah, we have actually not mentioned any timelines because right now we are with spare capacity.
Right.
And it doesn't look as if we'll be start of capacity for the next 2 years. So we had slowed down this entire project. We saw that prices of commodity had gone up and our project cost was also looking at a substantial increase. So we decided to wait. During this waiting period, we decided that we will continue with our civil construction so that the plant is ready for receiving equipment. So that is proceeding as per schedule. Civil construction, most of it, over 90-95% should get over roughly by June next year. On the machinery ordering front, we haven't commenced ordering machinery yet. We have just initiated that whole process now, and we hope to commence ordering equipment between Jan and Feb next year. So once we start, if it goes as per schedule right now, then in Q4 FY24 we should have the plant operational.
Got it. Q4, okay, got it. Jan, Feb, you were saying you'll start ordering machines of Jan, Feb of calendar year 23, and similarly in Jan, Feb, March of calendar year 24, you think the plant should be operational given the things at this point in time, correct?
Correct, yeah. But let me qualify that by saying that call on whether we start or not has yet not been taken.
No, fair enough. No, I understand that. Got it. And sir, another question I had was in terms of, sorry, before that, so just a follow up on this was, so we have, you mentioned that you see that given the current scenario, you have enough spare capacity for the next 2 years, right?
Yeah.
Would that have, I mean, assuming that from as things stand from Q4, let's say the demand comes back and things are normalized, do you see any issues in terms of margins, in the sense that we may have to, in order to fulfill our capacity, we may have to go for slightly lower margins? Is that a scenario that you envision, or that won't happen? Assuming a normalized scenario, I'm not talking about the current scenario where things are still not normalized.
So margins will depend, meaning if now prices are already coming down for chemicals. They are still not down to the same levels as earlier, but again, it had gone up almost by 150%, and from the top now it has come down by roughly about, I think, between 50 and 65% for various products. But yeah, they are still about 20-25% more expensive than what they were at pre-COVID levels. So as that corrects, margins should improve, but margins are also a factor of competition. So when you see subdued demand, everybody sitting on capacities. The panic hasn't come into the market yet, but there can be a panic coming in with some suppliers who are sitting on inventory. So we have to wait and watch and see it carefully. Now, a person sitting on inventory will be sitting on very high cost inventory, because they have bought it earlier. So we have to also see how they start behaving in this scenario.
Okay, got it. And sir, just on last question on this point, in terms of competition again. So a large part of the competition, I would assume, would be from China for us. And over the last few years, and especially with all the geopolitics, there is a preference of moving away from China for a lot of suppliers, for a lot of customers. I mean, right now, again, you mentioned the demand has been challenged. And even during COVID, you had gained some market share and you've not lost that. So are there any chances of increasing market share further in, let's say, in your top 10 products, that you see that you can grow much faster than the overall market growth?
Very frankly, for the top 5 products, we don't see any chances of increasing market share drastically.
Sure.
We are more or less at an optimum position right now. And all customers would definitely want to keep 2 or 3 suppliers, so they always split buying from different people, because nobody likes, overall dependence on one single supplier. So I think we are optimal placed in those 5 products right now.
Okay. Sure, sir. Thank you very much and all the very best.
Sure.
Thank you. Before we take the next question, reminder to participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Dwanil Desai from Total Capital. Please go ahead.
Hi, sir. Thanks for the opportunity again. Sir, can you give capacity utilization number for Macrotech and NGL separately for this quarter?
We have been roughly at about, I would guess, around 70% capacity utilization.
So Macrotech also is operating at 70%?
Yeah, because what we did was all what was being outsourced out, we have now brought it back. So it is being manufactured in Macrotech now. So we have literally brought other outsourcing down to, I think, barely 1 or 2%. Everything is now being done either in Macrotech or NGL.
Okay. Because, I remember you saying that, in outsourcing generally, it's very difficult to take things back because people plan their capacity based on our outsourcing, and it's very difficult to take it back. So, will it mean that we'll have to work again in terms of gaining traction on outsourcing once situation normalizes?
Yeah, but we were looking at almost, a 12-month to 18-month hiatus where we would have, working on somebody else's factory when your factory is starving doesn't make sense. So we thought it's worth bringing everything back in, wait for everything to settle, and then we'll again start the whole exercise.
Okay, got it. And sir, I think, before this entire destocking and demand softness started, we were thinking that we should be able to grow at 18-20%, and barring FY23 from FY22 base, will we be again looking at that 15-20% growth from FY24 onwards?
We will definitely aim for a 20% growth for 24, yeah.
On the base of 22, right?
On the base of 22, attaining that is difficult, because first, all the demand which is lost needs to come back. So we would not be able to aim for that over 22 now.
Okay.
Over 23, yes, definitely.
Okay, got it. And sir, so you mentioned in one of the responses that incremental product selection, we are trying to look for products where China is the main competition. And a lot of people across the world are looking at China plus one. So are we getting any kind of a, soft signals from our customers that if we do those products, they may be able to give us entry into those products, and hence we are entering, or it is more of our educated guess with which we are going ahead with the product?
No, we have had very recent interactions just 2 weeks ago with customers, and it has been very encouraging. There are customers who are actually eager and willing and encouraging us to come with those products, because they really want to ensure that their supply chain is well diversified and they are not overly dependent on just one country source.
Okay. So there can be a ready market available for new products. Customers willing to at least give us an entry. Then scale up is a function of how we compete. But so that understanding.
The opportunity is very much there.
Okay. Got it, sir. Thank you.
Thank you. The next question is from the line of Pratik Chaudhary from Samarthya Capital. Please go ahead.
So for the capex, in terms of the EC approval or the product mix that we are planning to start with, will it largely be the top 5 products that we currently make that will also be made as for the capex whenever the production gets started in 2 years down the line?
No, our production lines for the top 5 products are pretty well set. we don't need to do any additional investment in terms of increasing their capacity. This is all meant for the other products which we have got. Now, the remaining 10, 15 products are showing very good signs of growth. And in fact, we saw a very steep decline in the top 3 or 5. And the newer products which we have introduced have helped us to stabilize the business quite a bit. So it's more for creating capacity for these products.
The newer ones.
Yeah.
And what is the percentage contribution of newer products presently? Revenue contribution.
Well, top 10 products are contributing 72% of our turnover.
Mm-hmm.
So the remaining 10 are contributing 28% currently, but their share is up from 20% to 28% of our turnover as compared to Q2 FY22. In Q2 FY22, our top 10 products were 80% of our sales. And Q2 FY23, top 10 products are 72% of sales.
Okay. So, just another part to the questions that I asked previously. For the new capex, I mean, these products are, the products that we will commercialize over there 2 years down the line. Most of those products are already being made by us currently, but maybe in a smaller size because they don't contribute as much right now to the top line. Is that correct? Or would we be introducing even more newer products than what we currently produce?
See, from 20 which we are at currently, we want to get to 25 by next year, for which 5 products are already in the pilot plant in the current year. So the basket is expanding. Next year we'll plan on another 5 products to go into the pilot plant. So in in FY25, we should have those 5 also coming out in commercial. So essentially the objective is to go from a product base of 20 products, APIs roughly, to 30 over the next 2 years.
And do these additional 10 products have they already been incorporated in the environmental clearance filing which you have filed for the new capex?
No, they are not included.
So you will have to ask for a product mix change over there.
Correct.
Okay. Okay. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Nasir Parekh from Native Capital. Please go ahead.
Yeah, hi. Thanks for the follow-up. My question is on currency. Do we have, all our customer contracts in US dollars or currency varies?
No, almost everything is in US dollars.
Okay. And what would be the FX gain loss impact, in our financials?
You want for
the first half, this quarter and half year.
Does it answer your question, Mr. Parekh?
Oh, no, I'm checking.
So sorry, sir.
So, in the first quarter, our mark-to-market had an impact of almost 2% as a loss, and in the second quarter, it was 0.7%, again as a loss.
So of sales, right?
Of sales, yeah.
Got it. And last question, you mentioned, 20% growth in FY23 for which basically will take us back to the FY22 levels in revenue. What is the view on margins? Can we get to 20%?
Sorry, can you come back again?
Sorry?
Can you repeat the question, please?
Yeah, my question is, you mentioned 20% revenue growth in FY24. My question was on margins. Where do we see the margins? Can we get to the 20% margin level, or is that still a bit uncertain?
No, I think we should be back at that level. Between 18-20%, yeah, we should be back at that level in 24.
Okay, got it. Thank you so much, Thomas.
Thank you. The next question is from the line of Ankur Kumar from Alpha Capital. Please go ahead.
Hello, sir. Congrats for an improvement in numbers. So my question, as in, are you saying that we will be having 20% growth in FY24 on the current numbers? Because current numbers are kind of down compared to the last 2 years.
I'm saying we are hopeful of growing by 20% over 23 year number, FY23, next year.
Okay, sir. And in terms of peak revenue potential, what will be the peak revenue potential when we fully utilize? As in the PPT, we were saying asset turns have been close to 3x, over 3x in the. So what is our peak revenue when you full?
Based on the current capacity we have got, we can attain a turnover of between 360 crores and 400 crores.
Sure, sir. Thank you, and all my other questions have been answered.
Thank you. The next question is from the line of Pratik Chaudhary from Samarthya Capital. Please go ahead.
So for the additional 10 products which we are planning to introduce, taking the number from 20 to 30, the product mix change, the approval for which we would have to seek from the ministry, how much time do you envisage for this? And whether it can delay our plans in any way? What's your current understanding?
I have not understood. What delay are you asking about here?
In your one of your previous answers for the question that I asked, you had said that you are for the product mix change, which for incorporating the additional 10 molecules, you will have to take permission from the Environment Clearance Department. Is that did I understand that correctly?
Yeah.
And how much time would it take is what I want to know further.
Typically, it takes anything from 6 months to a year.
Okay. And have you already filed for that, for this product mix change?
No. Right now, these products are in the pilot stage. So when we know after the pilot is finished, when we know that these are going to be commercialized, that is the time we'll approach for the change of product.
Okay. And it will take 6 months from that time for you to get the approval for
6 months to a year, yeah.
Okay. Okay, sir. Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Rahul Nachni for closing comments.
Thank you, everyone, again for participating in the call and for asking us pertinent questions about our performance this quarter and the outlook. In addition, suggestions regarding the content of our presentation will be highly appreciated and will help us establish a strong communication channel. We will do our best to provide you with additional data points that will enhance your ability to analyze and comprehend the business. If you have any additional unanswered questions, please feel free to reach out to TIL Advisors, our investment relations partner. Thank you.
Thank you. On behalf of NGL Fine Chem Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.